Good afternoon or good morning to you, or if you are joining us in a different time zone. Thank you for joining me today and welcome to the Equifax Canada Quarterly Business Credit Trends. I hope you all enjoyed some time off over the holidays and are well rested and ready to tackle 2024. As always, I'm Sinead Gleason, Business Solutions Product Lead here at Equifax, and I'll be taking you all through today's webinar where we will look back at the third quarter of 2023. Before we get started, though, I'm going to pass things over to my colleague, Sandra, who will walk us through a few housekeeping items. Sandra?
Thanks very much, Sinead, and good morning and good afternoon, everyone. Each area within the On24 webinar platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the media player, so feel free to enter any questions you may have, and we'll try and address them throughout our session today. In the event there's too many questions to get through, we'll reach out to you individually to follow up in the coming weeks. Our presentation, as well as some related content, is available in English and French in the related content area. And our session is being recorded, and you'll receive the on-demand link via email tomorrow. We'll also have a couple of polling questions today, so keep an eye out for those. And you can provide your answers right within the platform by selecting the appropriate option. Some additional features you'll notice at the bottom of your screen. There's reactions. Let us know how we're doing. Register now for our upcoming Credit Health webinar and demo on January the 18th. Our survey that's available at any time during our session and will also pop up at the end of the webinar, and contact us. Feel free to check any of these out and provide your feedback. We really appreciate it. Now let's get started. Sinead, over to you.
Thank you, Sandra. Okay, so today it is pretty cold and blustery in the GTA. Winter appears to be making a fashionably late appearance. But today we're going to be taking a look back at the dead of the summer months and reviewing the state of the Canadian business credit environment in Q3. So in the third quarter, Canada's GDP began to slow, and after a slight incline in Q2, CPI came back down again. These and other factors prompted the Bank of Canada to hold rates steady. And according to a Statistics Canada survey of businesses that received a CEBA loan, nearly 72% had not paid it back fully. And in fact, 34% of businesses with an outstanding balance did not anticipate repaying those loans by the end of 2026. And I will take a couple seconds here to set this slide up. So on the left-hand side, we have a graph of the Canadian Retail Sales Index. Total retail is the gray line, and retail excluding auto is the red line. It's indexed from January 2022 on the far left side of the x-axis to October 2023 on the far right. And on the right-hand side of your screen, you have the average consumer credit card spend. The x-axis is January through December, with each year being represented by a different colored line in the graph. And what you'll note is that spending was down this year compared to last year. That's the green line compared to the blue line just above it there. Now, if we consider that our population has also increased substantially during the last 2 years, and that the retail sales numbers that we are seeing are total sales, what we might actually be seeing is a decrease in per capita retail sales, and a pullback in consumer spending will definitely be affecting Canadian businesses. Okay, and not only are we seeing pressure from decreased consumer spending, but so too is there pressure coming from continued increased labor costs, as well as continued increased input costs. So on the left-hand side, you're looking at the average hourly wage, which just keeps on climbing. And on the right-hand side is the Industrial Price Index, which is a measure of the price of major commodities. And over the last couple of years, the price inputs have climbed significantly compared to pre-pandemic periods, just adding to the pressures of the cost of doing business in Canada. Okay, so to capital. With those rising interest rates that we are seeing, increased cost of doing business and consumer pullback on spending, let's take a look now at all of those impacts and see what impact had on the credit landscape. All right, so what we're seeing in the third quarter of 2023 is three key trends emerged. Higher interest rates and economic slowdown are impacting new credit growth, and we'll see a tightening cash flows as that cost of doing business remained high, and more businesses are starting to default on payments as financial stress is increasing. So we saw a nice change. What we're looking at here is the new business openings. And this quarter, we saw a nice change from the last 2 years with respect to new business openings. We typically see a drop in new business starts during the third quarter. But this year, we saw higher than average third quarter to the tune of 21% year over year. BC and Ontario in particular reported stronger than expected growth. And when we look at outstanding balances reporting on financial trades, so those are those credit products that are issued by banks, those are up 4% versus the same period last year, and they sit at $30.6 billion. Mind you, that growth has slowed compared to what we saw last year. And then looking regionally at those balances, we can see that the 4% growth was largely fueled by Ontario and BC. And there are a couple of things going on there. If you recall, we saw an increase in new business starts in those provinces, but it's accounts that were open through 2020 to 2022. So older accounts, which are driving the balance growth. Because newer accounts are reporting lower origination balances, which we'll look at a bit more closely later on. And it's the higher risk accounts that we're concerned about here. Businesses with a financial trade delinquency score of less than 680, which are accounts that are at a higher risk of defaulting, saw an 11% increase in balances. And that was even more pronounced in Ontario, where that number was 17%. Okay, and on the left-hand side of your screen here is the growth of inquiries by risk segment. So with the highest risk segments, those are displayed on the far left-hand side. And across all of the score bands, we see an increase in credit demand, which is measured by inquiries. But a lot of these inquiries are coming from higher risk businesses. So the proportion of higher risk businesses seeking credit rose from 17.7% in Q3 Q3 2022 to 21.8% this year. And the story is the same across the country, with most provinces seeing double-digit growth when compared to the previous year. But demand is still lower than it was pre-pandemic across most provinces. And although we're seeing higher demand for credit, that's not necessarily translating into an increase in account openings. On this slide, the line graph on your left displays the number of new accounts opened in each month. The blue line represents financial trades, and the orange line represents supplier accounts, which we call industrial trades. So while the supplier side has reported some stable growth, banking lenders appear to be a bit more conservative as new financial trade originations are lower by 20% from the previous year. And those new accounts are being issued to businesses with lower risk scores. So for supplier accounts, 73% of new accounts were opened with businesses whose commercial delinquency score was greater than 481. And for financial or banking accounts, it's almost 90% that were opened with businesses whose financial trade delinquency score were greater than 741. So those are the ranges for the medium to lower risk score bands. Regionally, the story is consistent across all the major cities, with the exception of perhaps supplier trades within Toronto. That's the only one real standout, which is represented by the gray line on the graph on the left-hand side. There's quite a pronounced increase this quarter for supplier trades in Toronto. while on the financial trade side there on your right-hand side, we see that conservative approach is displayed across all major cities. And insolvencies in Canada have now well surpassed the pre-pandemic level. Proposals have started to edge up, and bankruptcies have grown by 36.5% compared to the same period last year. Alberta is the only province to report a decline in insolvencies. And so I will pause here and do a quick poll, and let's break up the monotony, make sure that you're still paying attention. Let's see if your responses are going to line up with the data we're about to look at in the next few slides. So Sandra, would you mind pulling up polling question number 1 for me, please? Okay, so audience, if you'll indulge us, based on your own observations, the current delinquency volume trend is it increasing, stable, decreasing, or you're just not sure? Let's see what you guys have to say. And then once all of your answers have come in, then we'll go to the responses and see how that looks compared to the data. Let's see if you're still paying attention. Okay, let's see what the results look like. 82% pretty much are saying that the delinquency volume is increasing. 13.8% say it's stable, 0.5% decreasing, so that's great news for those of you who are seeing that, and 4% not sure. So for that 4%, let's go and now flip it back to where we were. I don't remember the slide number that we were on, slide 16. I'm gonna go there right now. Okay, so delinquency rates. On the left, we display the delinquencies of those supplier trades. And on the right-hand side are the banking trade delinquencies. And you'll notice that the delinquency rates are now rising clear across the board. Both early and late stage delinquencies are up this quarter for both the supplier and banking trades. You know, it's clear that the economic pressures that we've been seeing this past year, they're beginning to mount and having a real impact on the ability for Canadian businesses to repay their obligations. And so to recap, we saw higher demand for credit by businesses with riskier credit scores, but lenders, both banking and suppliers, were reacting more conservatively with lower account openings and origination amounts and to less risky businesses. So this really points to a tightening credit market. We also saw rising delinquency rates and increased insolvencies. So what lenders can keep in mind as we head into 2024, make sure your strategies are in place to address that increased demand by assessing the risk versus the opportunity. You know, perhaps take a more regional approach and keep in mind too that consumer spend and credit behavior will have an impact on businesses. So be sure to keep well informed on those trends as well. Okay, let's dive a bit deeper into each of the various banking credit products. So first, we'll examine credit cards, where we're going to see higher usage. Okay, if you've joined us for the last several quarters, you'll know that we've been watching balances grow on credit cards. In the third quarter, balances grew by nearly 11% compared to the same period last year. On this slide, we have the growth of balances on the left and the growth of the number of accounts on the right. We had been seeing considerable growth in the number of new credit card accounts during 2022. However, now you'll notice that there has been a definite leveling off of new account activity. So the yellow stack in the bar graph shows that the second quarter had been trending strong each year with new accounts until 2023. There's definitely been a pullback in the number of new accounts this year. And the biggest drop in originations came from businesses with low credit scores. And turning to delinquencies on cards, what we're looking at here on are the late stage delinquency rates. The scale has been adjusted so that you can see that slight growth, but it's just sitting at under 4.1% now for the 60-day plus delinquencies, which is a 2% increase versus last year. The growth in the number of new cards issued is possibly masking some of the general financial strain that we're seeing broadly, because coming up, you'll see a much different picture for other credit products. When we look regionally, Prairies had the largest increase, where we saw a growth of nearly 7% versus last year, sitting now at a 3.1% delinquency rate. The Prairies have also seen relatively slow growth in credit card balances when compared to other provinces. So 2.1% versus 10.8% year over year nationally. So businesses in the Prairies region seem to be struggling more than the average. Quebec was another notable region where late-stage delinquencies rose by 3.7%. There we go. Okay, so now let's take a look at lines of credit, where we will see a drop in new account openings and higher balances. On average, balances on lines of credit have grown by 6% this quarter compared to last year. BC and Quebec both saw the highest growth rate in balances. And when we look over on the right-hand side at the number of new accounts by quarter, you'll see quite a considerable difference between the first quarter trend and the second quarter trend. There isn't as strong a change as we had been seeing for quite a while. And in fact, like we saw with the cards, the sharpest declines were with businesses who have lower risk scores, again, signaling a more cautious approach by lenders. And looking now at delinquency rates on those lines of credit, the 60-plus delinquency rate has jumped a significant 14.3% compared to the same period last year, with the number of accounts in default having risen 8.3%. And I know correlation does not equal causation, but we do see those rates increasing as the policy rate rose throughout the last couple of years. We noted in the previous slide that average balances on lines of credit were lowest in Quebec. They were around $15,000, which was up nearly 10%. Well, late-stage delinquencies rose by nearly 10% as well, although they sit at a relatively lower rate of 1.1%. Early-stage delinquencies in Quebec, which those are the 30-plus days delinquent accounts, those rose 21% year over year and now sit at 2.1%. Which suggests that borrowers are beginning to feel some strain in that region as well. Okay, so installment loans. Lastly, we will see that the new account openings on installment loans are up, but with lower balances and a general trend of continued balance declines. Okay. First, let's have a look at the trend, which is the bar graph on your left. And you see there's been a consistently downward slope there for the last 2 years. The average balance now sits at $126,000, which is down nearly 3.5% from the same period last year. And on the right-hand side of your screen, in the line graph, the gray line represents the number of new accounts each month, and the red line represents the average loan amount. So while there has been an uptick in originations during the last couple of quarters, the average loan amount has been dropping. And like we saw with the other credit products, the biggest drop in new originations came from businesses with low credit scores. And turning to the delinquency rates on installment loans, we see that as the policy rate has settled at 5%, delinquency rates have steadily climbed to around 3.5%. These products have fixed interest rates, generally speaking, and the corresponding rise of delinquencies is likely the spillover effect of all the market pressures that businesses have been facing. Nationally, the delinquency rate for installment loans was up 14.6% compared to the same period last year, and that is largely driven by the eastern provinces. Ontario has a particularly pronounced increase there to the tune of 27%. And then finally, let's recap what we saw across all various financial credit products. In cards, we saw continued strong growth from both new and existing businesses, with the average balance per business rising. With lines of credit, we saw that high interest rates are pushing debt levels up, and we saw that missed payments are increasing since interest rates have been growing. And with installment loans, balances have been steadily dropping since Q3 2022. There could be a shift in credit usage from loans to lines for businesses seeking flexibility in payments. So what should lenders be thinking about in this environment? When evaluating businesses, ensure to get a holistic view of all credit product usage for the businesses. Continue to monitor credit utilization levels on revolving products. Consider debt consolidation, perhaps, or balance transfers from high interest rate products to lower interest rate products, in order to help ease pressures on businesses. And lastly, keep your eye on changes in business credit scores for early identification of financial stress. And that brings us to the second half of our webinar. But before we go there, let's have another attention span relief break and see if your predictions will be aligned with what our guest speaker is going to take us through next. Sandra, would you mind pulling up our second polling question, please? Thank you. Okay, so audience, if you're still with us, to what extent do you agree with this statement? 2024 will see a more favorable economic environment for Canadian businesses than they did in 2023. Do you strongly agree? Do you agree? You're not sure? Disagree? Or I strongly disagree? And I wish I could get these answers regionally, but alas, that would be some sort of polling question magic that we cannot do. So we're just going to have to go with the general consensus and see what everybody thinks, and then let's see if we can go to the responses. Let's see the results of our poll. Okay, so the question was, to what extent do you agree that 2024 will be more favorable for the Canadian economic environment? And 28% agree, 20% aren't sure, 43% disagree, and 7% strongly disagree. So that's very interesting. So that's a great segue into our panel portion. Okay, so let me go back up to, there we go. Time to introduce our guest speaker. Today's guest speaker leads a team of experts who analyze economic data to identify business and sector trends impacting Canadian entrepreneurs. He's a seasoned speaker, regularly travels across the country to help business owners understand the risks and opportunities presented by the economic environment. He's responsible for providing economic analysis and advice to the bank's senior management team and supervises all marketing and industry research activities. In addition, he's president of the Financial Services Capital and Economy Committee of, okay, here we go with my French accent, Fédération des Chambres du Commerce du Québec, FCCQ. So please welcome Monsieur Pierre Cleroux, VP Research and Chief Economist with Business Development Bank of Canada. Welcome, Pierre. Thank you so much for joining us today.
Well, thank you for the great introduction. Good afternoon, good morning, everybody. So my presentation has two parts. First, I'm going to talk about the economy to try to give you an outlook for 2024, which should we expect for this year. The survey was really telling. A majority of people are saying that the situation is going to get a bit more difficult. Actually, I believe 2024 is going to be in two parts, and I'm going to explain why I believe that a little bit later. The second part of the presentation, I'm going to give you some data that we collect at BDC on SMEs, on small and mid-sized firms, including their profitability and how they see the financial market. So let's start with the Canadian economy. Where are we now? Well, as you know, the interest rate has been increasing very rapidly over the last 2 years, just because the Bank of Canada wanted to reduce inflation. So inflation has been a problem in Canada. We had inflation up to 8%. So as a result, the Bank of Canada has increased interest rate. When you increase interest rate, what happened? Well, people pay more for their loans, for their mortgages, for their line of credit. So, and in Canada, actually, the total payment paid on loans from consumers has increased by 50%. So that's significant. People have to make choices. And as a result, they are, I'm sorry if my graphs are a little bit funny. I think the structure or the format change in the transition to this webinar. So we'll try to understand anyway. So for example, the red line represents services in Canada. They have been plateauing. They have been flat over the last 6 months. Same thing with goods. And Shania talked about that a little bit. People are not consuming as well. I'll give you a specific example. For example, the amount of clothing sold in Canada dropped by 14% in 2023. Car sales dropped by 9%. So as we can see, when you increase interest rate, people are reducing their spending. And another sector that is really impacted is the housing market. The housing market has been slowing down since interest rate has been increasing. This is important for Canada because it's had a negative impact on construction. We're not building as many houses, and as a result, the number of jobs in construction went down. So the impact of higher interest rate is really felt on the economy. This is the GDP per quarter. You can see since the interest rate has been increasing, which is the second or third quarter of 2022, the economy has been slowing down. And the last quarter, we had negative growth. So this is not a surprise. This is what the Bank of Canada was trying to achieve. In order to reduce inflation, you need to slow down the economy. You need to relieve some pressure on price, and that's exactly what's happening. The good news is inflation is actually declining. So from 8.1%, we're now down at 3.1%, which is very close to the target of the Bank of Canada, which is around 2%, with a bracket between 1 and 3%. So at 3.1, we're very close. We're not at the objective of 2, but we're getting very close to that. There's still some challenges that are remaining. For example, food inflation is still elevated at 5%. Shelter inflation is high, but that's more related to interest rate. But for example, salaries are still increasing at 5%. So we still have some challenges to reach the objective of 2%. But there's a lot of good news. For example, inflation, if you exclude interest rate costs, it's at 2.2%, which is very close to the target of 2%. The inflation for durable goods, which are cars and furniture, it's now at 0.7. So as you can see, the strategy of the Bank of Canada has been working. By increasing interest rate, the economy is slowing down, but the objective to bring back inflation at 2% is actually, we're getting close to that. So this is where we are. This is where we are at the beginning of 2024. Interest rates are still elevated at 5%. The economy has been slowing down, but inflation is decreasing. So this is the starting point for this year. What should we expect for 2024? Well, for us, the key factor is going to be definitely interest rate. Interest rate has the power to slow down the economy like it has over the last 6 months, or to stimulate the economy. So this is going to be the main factor that we're going to watch for 2024. So first, we believe that we're done with interest rate increase. The economy is slowing down enough and inflation is progressing enough that we don't believe the Bank of Canada will keep increase interest rates. If they do, the risk of having a recession is getting much bigger. So I don't think this will happen. They will reduce interest rate this year. The question is when. What you see in red on the graph, it's our forecast. And we believe that by the middle of 2024, the Bank of Canada will be able to reduce interest rate. Why not now? Well, because inflation is not totally to the target. So they want to make sure that they anchor inflation expectation to 2%. So they will probably wait another quarter or 2 quarters and before they start reducing interest rate. But the economy is slowing down enough that there's a kind of a consensus among economists that the Bank of Canada will reduce interest rate this year. And this is important because when they start to reduce interest rate, well, the economy will pick up again. We'll see more momentum in the economy. So for the next 6 months, probably the economy will continue to be slow, but the last 6 months of 2024, we should see more economic activities in Canada. The reason why the economy will continue to be slow is because we haven't seen the full impact of a higher interest rate on the economy. So far, 47% of Canadians have renewed their mortgage. But in the next 12 months, another 65% are going to renew their mortgage at definitely higher interest rate. So the impact on the economy is not fully there yet. And in 2025, 2026, the rest of Canadians will renew their mortgage. So that's the reason why we believe the next 6 months will continue to be a slow economy. Another reason is inventory in Canada are very high. That's a reflection that the economy is slowing down. So a lot of business got caught with too much inventory. So that's when that happened, we see a slowdown in the manufacturing sector, for example. So we are expecting the manufacturing sector is already slowing down, but that will continue because of high inventory. Business investment has been slowing down. It's still more elevated than previous recession in 2020 or 2008, but they have been slowed down over the last 2 years, and they won't increase before interest rates start to decline. So that's another reason why the economy will continue to be slowing down. And finally, our exports are still solid, but they are not increasing anymore. They have been flat in 2023. So as a result, that's another factor that is keeping the economy in the slow growth. But there's some factors that will help the economy. So higher interest rate is slowing down part of the economy. Some factors that I'm going to explain are going to help the economy. And as a result, we believe that we're going to be able to avoid a recession. So these factors, the most important one probably is population growth. So last year, the population in Canada increased by 2.9%, which is almost a record. We have to go back to 1957 before to see a high number like this. So immigration has been very strong, and immigration will be strong in 2024. So this is helping the economy. When people come, they need a place to stay. They also shop. They need services. They need to buy products, and this is really helping the economy. So that's one of the factors. Another factor is the fact that savings are very elevated in Canada. They are 3 times the level we had in 2019. So this is important because although consumers are cautious right now, but they have money. When they have the confidence that interest rate will go down and they are more confident about the economy, they will start spending again, and they have the money to do it because they have a lot of savings. Another important reason why we are optimistic is because the unemployment rate remains quite low. So despite the fact that interest rate has been increasing for almost 2 years now, the unemployment rate in Canada is still relatively low at 5.8%, which is not the lowest, but it's much lower than in 2008, the last recession, for example, where the unemployment rate was almost 9%. So this is a good news because when people keep their job, well, they keep spending and they are keeping the ability to pay their mortgage, which is my last point I want to make. On the positive side is the default rate on mortgages is still very low. It's almost at an historic low. And the reason is because the job market is good. So despite the fact interest rate has been increasing, Canadians have been able to absorb this increase, which is a good sign for the housing market. But the most important factor is going to be the rate cut. We believe that interest rate will go down probably in the second part of 2024. Some economists say in April. We believe more in June, so we'll see what happens. But this will stimulate the economy. This will stimulate the economy because the housing market, for example, which is very sensitive to interest rate, will pick up again, which create jobs. Business confidence will be renewed, and business will reinvest again. And consumer confidence will also increase, and that's a good news for consumption. So this will help the economy, and that will probably prevent the Canadian economy from being in a recession. So our forecast for this year is not a recession, not a negative growth, but a slow growth. Especially in the first part of the year, we believe we have negative growth for some quarters, some positive growth. You might hear that We have 2 quarters of negative growth. We might, what the media is calling a technical recession, but we don't believe we're going to have a recession. The job market is still very solid, and the growth is going to be modest, especially in the first part of 2024, but it will pick up again in the second part of 2024. Overall, we have growth below 1%, and we'll have to wait until 2025 before we see stronger growth in the Canadian economy. So the second part of the presentation, I wanted to talk about the small business financing condition, which is very consistent with what Sinead has presented you. But we have a kind of a different angle, and I think it's interesting. So for example, every quarter, we keep track of financial situation of SMEs. 62% of small business are profitable now, and another 25%, they say they broke even. So it's about 13 to 14% who have negative profit right now. So this is a bit lower than what we have seen in 21, 22, but this is actually quite solid. Having said that, 66% of small business have debt, and 50% have more debt today than 12 months ago, reflecting the fact that interest rate is increasing, reflecting the fact that the economy is slowing down. And if we look by sector, you can see that the manufacturing sector is where the level of debt has increased the most, but it's quite different from one sector to another. Something that we find very interesting is we wanted to see the impact of increasing interest rate on small business. And the first thing we realize is smaller businesses are paying much more in terms of interest rate. So if you look at under the circle, it's a bit hard to read because the format is has a bit shifted. But for commercial loan in Canada, the average interest rate paid by small business is 12.6%. compared to 6.5% for bigger businesses. So the first, small business has always paid more in terms of interest rate because they represent a bigger risk. But the gap has been increasing over the last 2 years as interest rate has been increasing. So you see the gap is quite wide right now. So small business are more impacted by higher interest rate than large businesses. Another factor that is interesting is small business are much more likely to have flexible rate than large businesses. We believe it's because when you are bigger businesses, you have a CFO better equipped to negotiate, better equipped to have a strategy for interest rate. But nevertheless, it's having quite an impact on smaller businesses. So businesses with a variable rate has seen their debt increase much more significantly than businesses who have a fixed rate. Also have a bigger impact on their profit reduction. So in our research, we find that businesses with a flexible rate have been more negatively impacted on their profit than business with a fixed rate. So this is also reflected by size of firm. Businesses who are, we call micro businesses with less than 5 employees has been more impacted by higher interest rate than others. That's also true with business with a variable rate compared to the one who have a fixed rate. So by increasing interest rate, you don't have the same impact on different kind of business. That's what we find. It's more difficult for small businesses. The demand for financing is still strong, but it's different than what used to be. One of the reasons is the people or businesses who are asking for financing, they are not as profitable than the overall small business. These numbers are totally consistent with what Sinead presented. Is actually businesses who are requesting financing, they are not as bankable as they used to be before interest rate increase. And that's the reason is because the impact is a bit bigger actually for small businesses. So we find that the demand is still strong, but the demand is different. The demand for financing for growth-related projects or buying machinery and equipment is going down. The demand for buying a building or investing in a building is down as well, and as well as business transition. However, the demand for financing more related to the current situation is increasing. So short-term financing, line of credit, business credit card, or working capital loans has been increasing as more and more businesses need more financing to go through the slowdown in the economy. Over the last few months, we're starting to see that it's also the situation for bigger loans. So it took a long time, but the market is also tightening for bigger loans. That's what we find in our research. So in conclusion, the economy is slowing down, and this is not a surprise. This is actually what the Bank of Canada wanted to see. They want to reduce inflation. In order to do that, you have to slow down the economy. So far, the strategy is working. The economy is flat, and the inflation is almost back to target. So we are expecting that the Bank of Canada will reduce interest rates in 2024, and that will stimulate the economy, especially in the second part of 2024. Not a recession, a soft landing. The first 6 months are going to be flat, but the last 6 months of 2024, we should see a bit more growth in the economy.
That is great. Thank you so much, Pierre, for sharing that. It's nice to see, sort of the research and the insights that come from BDC. They're lining up very, very much so with what we're seeing on the Equifax side. So it'll also be interesting to watch what happens in either April or June. Who's going to be right? Who's going to win that race? But yeah, definitely something for us to watch. It's comforting to hear the predictions are we're looking at, I guess, a softer landing is really what the phrase that's used is. So thank you for sharing your insights. We actually do have time for questions and answers. So we're going to look at the questions that have come in, and let's see if we've still got about, we'll go with 10 minutes. We won't keep everybody here too long. So Daniel asks, how confident are you in using credit card balances as a proxy for overall spending patterns? So cash versus debit. I'm not sure if that's a question for Equifax or for BDC. So Pierre, would you like to, do you want me to field that one? I'll field that one then, unless Pierre, if you have any thoughts, but in terms of—
Go ahead, and I can add something maybe.
Sounds good. Okay, so in terms of using credit card balances as a proxy for overall spending patterns, cash versus debit, I think we've seen consistently that credit card balances are a good indicator of overall spend. So in terms of our data, we're very comfortable that that's a good proxy. We obviously are not able to measure cash transactions and debit transactions, but I think the consensus has been that that is definitely a strong proxy. Pierre, I don't know if you have thoughts on that yourself.
Well, just to add that what we are seeing is consumption is slowing down. And this is not surprising because as you increase interest rate, they have to make choices. And the numbers I show, the impact is bigger on some items than others. So some items like clothing, sport items, even cars, people are more cautious. They delay their purchasing, and we believe it's going to be the case for the next 6 months until interest rates start to decline.
Yeah, I would agree. Okay, Shen asks, is the FTDS score, so that's the Financial Trade Delinquency Score, equivalent to a consumer credit score? And I would say yes, you can think of them as very much equivalent. Obviously, consumer credit scores are built with consumer spend patterns in mind, consumer data in mind, and the algorithms are based off of that. But the same is true for financial trade delinquency scores and even our CDS score, the commercial delinquency score. So they're very much, what a FICO score would be on the consumer side. They would be the same notion on the commercial side. So yeah, so generally speaking, lower scores are higher risk. And then Ganesh asks, how would your outlook change if the government of Canada reduced the immigration target this spring? Or what your thoughts are there?
Well, actually, immigration has been helping the Canadian economy. our consumption would be much lower without immigration. The reason why immigration is so high is because we have an aging population in Canada. We need more workers. There's a lot of Canadians retiring. The baby boomers basically are retiring, and we need more young workers to replace them. So I don't think they will change the target because the job market is still very tight, and we need more immigration. But if immigration is slowing down, well, this is not going to help the economy.
Right. Federico asks, pardon me, how do you explain the fact that households currently have more net savings? Is this due to less spending?
It is, and the shift happened during the pandemic. People save a lot of money during the pandemic. There was a good reason, as you may remember. We couldn't travel, couldn't go to restaurant for a while, so people save money. But still, now that the economy is really full open, people are more cautious than they used to be, and they kept this habit to have more savings, which is good, because when the economy restarts, when the Bank of Canada reduce interest rate, there's going to be still a lot of money in the economy that should help consumption and the housing market.
Yeah. Okay. We have another question. Again, I'm not quite sure if this is for Equifax or if this is for BDC, but can you provide some color on the delinquency and loss performance on small business loans? Perhaps, Pierre, I'll see if you have any thoughts there.
Well, definitely, a higher interest rate has been had quite a negative impact on smaller businesses. They pay more in terms of interest rate. Like I said, the average interest paid by small business is almost 13%, which is very high. Also, they are much more likely to have a flexible rate. So they have been much more impacted by the higher interest rate. And some sectors also have been more negatively impacted by the slowdown in the economy. We can think about the restaurant sector, accommodation, the retail, typically where we have a lot of small business. So that's explaining why it's more difficult for them to repay their debt.
Yeah, definitely. I would say that that's absolutely true. Jasmeet asks, do you know if certain industries are more stressed than others? And I like that you had those industry breakdowns there, so I'll be curious to get your thoughts on this. He asks, should lenders tighten lending towards these industries?
Well, definitely some industries has been more impacted. We can think about food and accommodation, retail. Those sectors are the two sectors that are more impacted. And they have more difficulties to repay their debt. That's especially true for the food industry. So obviously for lenders, you have to be more careful about these sectors these days.
Yeah, I would say so. And just really take a look at a more macro level. The more data, the better. Okay, so what role do you think current geopolitical issues could factor on forecasts? Which impacts are most concerning? Supply chain, oil, any others? That's definitely a question for you, Pierre. That's not one I can tackle.
Yeah, there's a lot going on around the world, but we are fortunate in Canada because we have been quite isolated from these factors. For example, the war in Ukraine didn't really have a negative impact in Canada, which is not the case in Europe. For example, European countries have been paying much more in terms of energy, which is not the case in Canada. So we have we didn't have any negative impact because of the war in Ukraine. And same thing with the war between Israel and Palestine, between Hamas and Israel. We don't export much to this region. We don't import much from this region. So we haven't seen any impact on the Canadian economy. What we are really following is the US. As you know, 75% of our export are going south of the border. So what's going on in the US is really having a great impact on Canada. So far, the economy has been very resilient, very good, actually performing better than the Canadian economy. But interest rates are high. So we are following the situation in the US very carefully. And I would say one factor you should watch for at the international level is really the U.S. economy.
That's great. Yeah, that was Peter's question, who asked how you think the U.S. economy will impact our economy this year. So,
well, we're quite confident. The U.S. economy has been very resilient, and we believe that interest rate will also decline this year in the U.S. because inflation in the U.S. is less than 3% now, so they are very close to reach their target at 2%, just like for Canada. So we believe we're going to have not a recession, but a soft landing in the U.S., which is good for Canada because a recession in the U.S. will have quite a negative impact here. So we actually the U.S. will probably perform better than Canada in 2024.
that's great. Okay, well, thank you so much for sharing your insights. I think with that, we will actually have one more question. One more question in terms of CEBA. So what exactly would the question be, Stephen, who's in the room with me?
With CEBA loans coming up due, how do we see that impacting small business?
Oh, okay, so that's with regards to CEBA loans coming due next week, I think is that deadline for the early repayment. And after that, the interest rates kick in and that forgiveness portion goes away. And actually, I've been kind of watching the news feed where there's been increased calls and pressure, particularly within the restaurant industry too, and food industry about CEBA. Can you share your thoughts quickly before we let everyone go with regards to what that might, the impact that might have on small businesses?
I don't think it will have a big impact for two reasons. Our research is showing that most businesses will be able to repay before the deadline. And the second reason is we tend to forget that even if you're not able to pay before the deadline, you have access to a low interest rate loan by the federal government for another 2 years. So it doesn't mean that you have to repay immediately. You still have some time to do that. So I don't think it's going to have a major impact.
Okay, great. Well, thank you for your thoughts. That was the last question. So thank you again, Pierre, for joining us. Much appreciated. And as always, thank you, audience, for joining us too. I truly appreciate the engagement and also that you take time out of your schedule to spend a whole hour here with us to hear about the state of Canadian businesses. And so with that, wrong one. I'm going to go to... thank you very much. Our next Equifax webinar will be a week from today on January 18th. My colleague Marco Merrick will be discussing Equifax Credit Health, which is the delivery of Equifax credit scores through a seamless digital experience. So if you like what you saw here today and you'd like to learn a bit more about that, there is a link to that registration in the platform, in the portal here. So once again, thank you also to the magicians behind the scenes, to our production team. Teamwork makes the dream work. And with that, I'm going to let everybody go a little bit early. You can all grab coffees before your next meeting. So have a wonderful rest of your day, everybody, and we'll see you.